Good morning, good afternoon, good evening, wherever you are. I'm David Wu. Welcome to the Money Game, where we make actionable predictions about the big stories shaping the world today. If you're interested in making money, you're in the right place. If you're not, this program is designed for anyone who's just interested in learning what makes our world tick. Please subscribe at davidunbound.com if you haven't done so already. My podcast last week on COVID's coming fifth wave generated a lot of interest. On one hand, Pfizer stock price went up every day last week, and that made me a very happy strategist. On the other, I was getting some serious pushback from some people. In fact, I had one subscriber canceling his subscription, accusing me of sounding like the New York Times. Ouch, that hurt. If you don't mind, I'm going to take a few moments at the start of this program just to simply defend myself, especially on philosophical ground. I will be the first one to admit that COVID has been the single most difficult issue I've ever had to examine as a Wall Street analyst. But at the same time, I also realize that unless I've got an informed view about COVID, I haven't got an informed view about anything else. Now, let me share with you 4 lessons that I've learned the last 18 months just looking at COVID. Number 1, some policies are just too difficult to implement politically, however good they may be. At the start of the pandemic, I was very much a supporter of the so-called Swedish approach, which was to, ring-fence the elderly, but to keep the economy open in order to allow herd immunity, natural herd immunity, to settle in as soon as possible for the rest of the population. However, it became very clear to me very quickly that notwithstanding the merits of this approach, it was politically impossible, even in Sweden. And this has to do with the fact that, number 1, our media is much too interested in sensationalizing the pandemic and promoting public hysteria. Number 2, our public health officials are much too risk averse. They cannot stand the idea of even one person dying. And thirdly and finally, the opposition parties across different countries have been much too eager to exploit, basically the political potential of COVID. Given the Swedish approach was difficult to implement politically, the only obvious alternative is rapid vaccine development. It didn't take very long for Donald Trump to figure that out, and that's why he launched Operation Warp Speed. Think about it this way. At the time, there were at least 300 vaccines under development. He picked 5 to give money to: Moderna, AstraZeneca, J&J, Novavax, and Sanofi. Right now, of the 4 vaccines that have been approved by FDA so far, 3 of them came out of Operation Warp Speed. So I don't care whether you like Trump, you don't like Trump. I would say there's no question that this policy under him saved millions of lives. Lesson number 3. The politicization of the pandemic is every bit as dangerous as the pandemic itself. From the very beginning of Operation Warp Speed, the Democrats tried to sow doubt in the mind of the general public about the vaccine, initially about how soon it was going to be ready. They said it was going to take 2 years and even more. And later on, they sowed doubt about the vaccine itself. Kamala Harris famously said, "If Donald Trump tells us to take it, I won't take it." I would argue there's no doubt that the politicization of COVID and the vaccine in the U.S., especially by the Democrats, is the main reason why the vaccination rate in the U.S. is far below that of other advanced countries. Lesson number 4, it's wrong to think that the only thing that matters is the case mortality rate. Now, a lot of you guys basically disagree with me about the need for a 3rd booster because you say, wow, vaccines, even if they become less effective over time against infection, they're still pretty effective against serious illness, hospitalization, or death for that matter. Let me tell you why I think you're wrong. If you look at this chart right here for Israel, what it shows you is that this past summer, Okay, despite the fact 85% of the population in Israel had already been vaccinated, we saw a surge, okay, in COVID that saw the absolute number of new confirmed cases basically exceeding what we saw earlier in the year during the third wave. What is equally important is that even though the case mortality rate was indeed lower than the previous wave, if you look at the absolute number of deaths, still came in at about 50% of what we saw during the third wave. In other words, what really matters here, equally important, is not just the case mortality rate, but also the absolute number of infected cases. And this is the reason why I think there is a strong case to be made about the third booster. Thanks for hearing me out, for letting me get that off my chest. Now let's get on with the program this week. This week I want to focus on ESG, energy, and the coming recession. There's no doubt that the big story of the last 3-4 years has been the rise of ESG, that stands for environment, social, governance, investing, okay? That has become a very, very popular, basically, form of investment. My view is that ESG, by now reducing the elasticity of oil supply with respect to oil price, is actually placing the global recovery at risk. I want to talk about why this is negative for the euro, for the RMB, and why that's bullish for defense contractors, but very bearish potentially for consumer discretionary. In my opinion, one of the most important, yet the most underestimated developments in the global economy of the last 10 years has been U.S. energy independence. In the space of just 10 years, U.S. oil production went from just north of 5 million barrels per day to 13 million barrels per day by the end of the decade, basically making the U.S. the biggest energy producer in the world. That was truly astonishing with many, many important ramifications. I can think of at least 3 major benefits associated with U.S. energy independence. Number one, there's no question that it allowed the world to meet the increased oil demand from the 2 fastest growing economies in the world, namely China and India. In fact, if it hadn't been for increase in U.S. oil production, it would have been impossible for the world to basically satisfy the increase in 7 million barrels per day in terms of oil demand from these 2 countries over the last 10 years. The second most important benefit of U.S. energy independence is that it drove down energy price volatility. In other words, freeing the world economy from being the hostage to the oil market, or for that matter, to OPEC as a price-setting cartel. This is why I would go as far as saying that U.S. energy independence is the reason why we had the longest economic expansion in the post-war period that lasted 130 months, that would have gone on perhaps for many more months if it hadn't been for COVID. Another major benefit of U.S. energy independence is that it forced the largest country in the Middle East, Saudi Arabia, to accept reform and to open up. In fact, over the last 5 years, Saudi Arabia has, removed impediment for foreign ownership of Saudi enterprises. It's actually introduced VAT to diversify away from oil revenue. It's even basically passed important bankruptcy laws in order to encourage greater entrepreneurship, all of which are important to bring Saudi Arabia into the 21st century. I would argue that the reform in Saudi Arabia was a necessary and sufficient condition to bring about the signing of the Abraham Accord, basically between Israel and UAE and Bahrain, which usher in a period of new peace in the Middle East. U.S. energy independence has done so much good for the world. It is rather amazing how little credit it gets from the world. I can only imagine this has to do with the fact it falls foul of the climate agenda. The irony, of course, is that now that the world no longer has to worry about an energy crisis, it has the luxury to worry about a climate crisis. A crisis that, rightly and wrongly, the world has decided is the fault of carbon emission. Rightly or wrongly, the public, has been persuaded that climate now represents a major issue. In fact, according to a UNDP survey, released earlier this year, 72% of the population in the developed world now views climate challenge as being an emergency. In other words, they're demanding that something is done about it. Rightly or wrongly, Wall Street is playing along with the public's growing concern about the environment. This is the reason why ESG investing based on environmental, social, and governance considerations remain extremely popular. This is also the reason why it looks like, the amount of assets under management in sustainability funds is set to double this year. Meanwhile, environmental activists have figured out that most of the financing for the oil and gas sector come from banks. This is the reason why big banks are under increased pressure to reduce their lending to the oil and gas sector. So therefore, the oil and gas sector is being hit on two fronts. On one hand, you've got the ESG conscious investor who are saying that they don't want to be associated with dirty energy. At the same time, you've got the banks that want to reduce their exposure to the sector in general. What this means is that the oil and gas sector is increasingly struggling to secure financing, even when there are attractive, basically investment opportunities. And this is probably the reason why over the past year, even as energy prices recover, we have not seen a corresponding actually increase in investment activity in this sector. And this is worrying because what this means is that if supply is not able to play catch up to prices, that means prices can keep going higher. The evidence increasingly suggests that the U.S. is not going to be ramping up its oil production in face of rising prices. But what about the Saudis, the other big oil producer? The reality is that as much as Saudi might still basically see itself as the producer of last resort, the Saudis in reality need and want higher prices, especially given the fact they're still running a large budget deficit. This means that the Saudis are likely to adjust their production upward, to slow the price ascent, but they're unlikely to want to stop oil prices from going higher. What about Iran? Certainly at the start of this year, a lot of oil traders were betting that, with the Biden administration taking office, we were going to see a deal very soon with Iran that will bring Iranian oil back into the international market. Of course, that hasn't happened. That can still happen, and that certainly represents a major downside risk to oil price, especially at this level. But nevertheless, it seems to me at least that the chance of basically, a successful renegotiation of the deal is becoming slimmer every single day. The reason is very simple, because on one hand, the Americans want to go back to the terms that were struck in 2015, whereas the Iranians want to start from scratch. They have a good reason to do so, especially given the fact that they're starting to enrich uranium already at 60%. And but the real basically problem, at this point for the logjam to be resolved is that after Afghanistan, I think Biden's ability to make significant concession to win Iran over is now increasingly limited. This means that actually the stalemate might continue for basically, in the foreseeable future, and that is actually bullish for oil price. In my view, high energy prices are going to be here to stay, and there are going to be clear winners and losers. Among the winners, no doubt, Russia will be a major winner. Saudi Arabia is clearly a major winner. I think to the extent that, the Saudis in general, Gulf countries are going to have more oil money, that is going to give them more war chests to go out and basically engage in investment in defense capabilities to contain Iran. That is actually bullish, ironically, for, defense contractors. There's also no doubt that high energy prices is only going to basically help make the case for people working from home. And that actually is going to be bullish for technology that enable remote work. No doubt about that. I would also argue that ultimately, what's going on here is going to be ultimately fairly bullish for oil majors to the extent they simply just going to be collecting coupons every day from high oil prices without doing too much work. Among the losers, there's no question that Europe is a major loser because they're a big importer of energy. China and India, big importer of energy, they're going to be big losers as well. The middle class is going to be a big loser because unlike the poor that don't have to get to work, you know what, the middle class, no question, I think transportation is going to represent a much bigger part of their budget than for either the very poor or for the rich for that matter. And SUVs, gas guzzler, are going to be losing out with high energy prices here to stay. The bottom line is that oil supply is becoming increasingly price inelastic. What this means is that it won't take very much for oil price to overshoot. For example, if we were to get a colder than expected winter, it is reasonable to think that oil price could potentially get up to $100 a barrel quite easily. But even with now $100 a barrel, even now, if you look at the year-on-year change in oil price, it's up more than 100%. And that as a magnitude in terms of the oil inflation is already similar to what we saw basically accompanying, the last 3 recessions. In other words, that a small shock from here that sent oil price to $100 a barrel could potentially tip the global economy into a recession in 2022. What is the outlook for energy price or oil price, more specifically in the very short term? To me, a very interesting clue is the fact that notwithstanding the big jump in oil price lately, the Dow Transport Index, which measures the performance of transportation stocks, has been actually rallying over the last few weeks, poised to take out the high that we saw only a few months earlier. That basically is an indication that the pent-up demand in the system for transportation is so great that actually high energy prices is going to be tolerated for the time being. And to the extent if the transportation sector can live with high energy price, then there's probably a good chance that energy price can actually squeeze even higher from here. Meanwhile, weather forecasts suggest that La Nina conditions are likely to remain in place for the coming winter. This means that at least in North America, that areas that are cold to begin with are probably going to get colder than usual. This probably means net that actually demand for heating oil is going to go up relative to the normal year. Another interesting fact about the oil market right now is the fact that when we look at positioning data, speculators don't seem to be heavily involved in this oil rally. In other words, positioning is fairly light, which is another reason to think that oil price could squeeze higher from here. I think there's a case to be made that the new credit constraint faced by the oil gas sector will be specially felt by new players, smaller players, because in fact you could argue the barrier to entry is going to go up. This should ultimately benefit the established players like the oil majors, whether they be the Chevron of the world, ExxonMobil, BP, and so on and so forth. Indeed, if you look at the dividend ratio of these companies, which are trading anywhere between 5 to 6%, you could argue that these companies should be viewed with the new lens as high dividend utility play. You could argue that the high dividend yield offered by the oil majors is a reflection of the risk that, fossil fuel could be phased out sooner rather than later. But I'm not too concerned about that risk. For one thing, I think it's going to take a lot longer than people expect for renewables to really basically reach critical mass. You can see even in Germany, one of the most advanced basically countries when it comes to renewable energy, only 17% of its gross energy consumption comes from renewable. And there's no doubt the experience of Europe this year, when you have poor wind conditions, next you know that natural gas price is going through the roof because there's a shortfall in electricity supply. Well, what's happening in California, where you're seeing actually the regular blackout, electricity, rationing, all this would suggest actually transitioning to a world in which that fossil fuel will be phased out is probably a long away. Europe is taking the lead in terms of the transition to clean energy. But even there, the choice is not that obvious. For example, if Europe wants to get cheap natural gas price, then most likely will have to accept to become even more dependent on Russia. Okay, something that is not clear the Europeans are prepared to basically do politically. Oil price is back at a 5-year high. but oil stock price is actually still below where we were at the start of COVID. Okay, from that point of view, I do think there is some value in owning oil stocks, as I said, especially given the high dividend yield, especially the oil majors actually might end up being a big winner from the new credit constraint, ESG, and so on and so forth. I'll be looking to basically buy ExxonMobil on dip or on a breakout above 65. Before I wrap up, I just want to quickly review my outstanding recommendations. I'm still long Pfizer, which I bought at 42. It's now small up. I'm still short Eurodollar, which I enter at 116. I'm small down. And I'm short IWN, enter at 220. I'm down 3%. I still like all these trades, and I'll be looking to add a long position in ExxonMobil, hopefully in the next basically week or two. Thank you very much for listening. Talk to you next week.